Welcome, folks. This is Tom O'Brien of TFNN. We're broadcasting live today from beautiful Manhattan at the Hard Asset Show. Our guest today, folks, we have a beauty. It's John Murphy from StockCharts.com. And, when you go back in technical analysis, folks, okay, this is the man who brought technical analysis to the forefront in the United States, specifically for me. I mean, bottom line is that, when you look over the years, I never knew anything. And then all of a sudden, watching you on CNBC, I'm saying, oh, well, how does this work? This is pretty cool. John Murphy, it's so good to see you, man.
Good to see you again, Tom.
Seriously.
It's a pleasure.
So, talk to me, your history is amazing. But when you look at the history and where we are in technical analysis now, right? Talk to me about the history of technical analysis.
Well, the history, it continues to evolve. There's no
Yes.
question about it. And more people use it. And now, because of the computer, things that I worked for Merrill Lynch back in the 70s
Right.
in their technical department. The average investor today has more technical tools at their disposal than we had working for an institution.
Amazing.
But I would say that for me, the biggest development in technical analysis is how closely correlated the markets are. I don't know if you remember, but I wrote a book, 10, 15 years about intermarket
Great
analysis.
book, that's right.
And I said, it's sort of a new direction. It builds on the technical. You still do the technical stuff,
Right.
but you have to understand the interrelationships. And I didn't even suspect how important that. When I look at the markets today, you could look at almost one market. You could look at the euro on any given day, or let's say the dollar.
Yes.
And if the dollar goes up or down, you can predict what commodities are going to do, what bonds are going to do, what stocks are going to do. They are so interrelated.
It's amazing.
And global markets,
Right.
what happens in China, if there's even a rumor of a rate hike in China, copper goes down, and all kinds of things
Yes.
happen. And that to me is maybe the biggest change that I have seen in technical, and that's where most of my emphasis is now.
You know what's so cool about that is that it puts together the technical skills.
Of
but
course.
What you also have is that's a fundamental skill, basically, that you're looking at those sectors and say, okay, if this happens, what is going to happen here? Particularly, you just brought up the euro and the dollar. I don't think folks understand that currencies are moving these markets, so dramatically.
Of course, absolutely. And another thing too is it bridges an important gap, because it used to be that we had the technical, then we had
Yes.
the fundamental and the economic.
Right.
And that still exists to some extent. But when we talk about intermarket work, I can talk about, for example, well, if the Europeans don't raise interest rates, that's going to be bad for the euro, that's going to be good for the dollar,
Okay.
that's going to push gold and silver down.
Yes.
So, and I can talk I could talk with a group of economists about how Fed policy is driving the price of gold
Sure.
and risk assets,
Right.
right? And so I can sit and discuss fundamentals. We're really discussing fundamentals. We're discussing economics.
Right.
I'm talking about the possibility of inflation
Sure.
resulting from Fed policy.
Right.
20 years ago, we didn't talk about things like that.
That's so cool. No, I'm with you because of those correlations, because they are direct, number one. You're looking at them technically. Someone else, it's amazing. You hear on the media many times, why did this just happen? Or this risk on, risk off. It's like, hold it. What are we talking about here, right? Because the correlation is so direct and intermarket.
And what I hear, for example, a lot of times I'll turn on, I'll watch a business show, and unfortunately in the New York area where I live, it's mostly Wall Street people.
Yes.
They don't understand commodities, they don't understand gold,
Right.
they don't understand foreign currencies.
Right.
And I can't tell you how many times I've heard people say, whenever the subject of gold comes up, there's no fundamental reason why gold should be going up. And I'll say that's insane. You've
Right.
got to look at the dollar.
Right.
You got to look at Fed policy.
Yes.
It makes, when the dollar goes down, gold goes up, and it's more complicated than that.
Sure.
But people are also trading gold as an alternate currency, which
Sure.
That's the fundamentals. So when someone says there are no fundamentals behind it, they just don't know what they're talking
It
about.
must amaze you that the battle more so 20 years ago than now was, you're a fundamentalist, that's where it's at, versatile or technical. And now that it's just the opposite, meaning you're hearing someone saying to you that it's not there and you're saying, no, hold it. It has to do with the dollar. It has to do with fundamental aspects.
And I can explain it in fundamental
Yes.
terms. I can say, well, the Fed is the only central bank in the world right now that isn't raising interest rates. I
Right.
think they're falling behind the curve. That's weakening the dollar. That's pushing up commodities. It's also somewhat good for stocks at this particular point. So I can sit and argue these things with a fundamental guy.
Right.
And just say, and if you want to argue, just look at the chart.
Right.
When Mr. Bernanke says, well, the falling dollar isn't what's pushing commodities up, we just look at him and say, what are you talking about? Of course it is. Just look at the chart.
Exactly.
So it weds the fundamental and the economics. So we're all sort of talking about the same thing. But the main thing is, while they do their forecasting based on economic things, I take it from the charts.
Right.
The market is always the leading indicator.
There's no doubt. You know, folks that are just getting started now, and in this aspect, it's pretty cool because I see a lot of younger folks getting started in technical analysis, just because it's been at the forefront for quite a while right now, right? What kind of advice you can give them?
Well, they have to get on the computer, get a website.
Visual investor.
Get the visual investor. Look at Stock Charts, which is our website, stockcharts.com. A lot of you can do a lot. Maybe there are other sites out there that do this as well. I'll give a plug for my own service, stockcharts.com. Most of it is free.
Right.
You can get on there and you can chart a lot of it free. You can even read my stuff, which is free.
Nice.
So it's a good place to start. Read a good book. You have a new book coming out, right?
I got a new book.
Okay.
Yes, I do.
So you have a new book coming out. Read a good book. Get on a good website. But I guess if I had to, my advice is to try to keep it simple. Don't you can get so caught up in the esoteric technical stuff.
Yes.
Leave that to the professionals. We do this for a living. This is all we have to do. We have nothing else to do. This is what we do all day. But if you're just an average investor, master a few techniques that make sense to you, and don't try to overanalyze it. Keep it simple.
When we were doing workshops together, a few years ago, right? I remember I'm sitting in one of your workshops, right? And you're watching and you're saying to folks, listen, if you have discipline, see this 50-day moving line? The bottom line is that if you pay attention to that, and I thought that was so intriguing, and because you are equating, saying to them, well, pay attention to it, make sure you get out or get in. And it's interesting because some people will and some people won't, but that till this day is pretty cool, isn't it?
It's one of the simplest of indicators, a 50-day moving average, and this is true. We're talking mainly of stocks here, not so much commodities. They have commodities and currencies have different indicators, but just a 50-day moving average. If you buy something when it, and I must admit I'm big in exchange traded funds. That's really what I specialize in, and most of my work is in stocks now. But when something closes under its 50-day moving average, it's usually a good sell signal. We had a good example of that of silver recently, or gold. Breaks under its 50-day moving average, you take some profits. It's just a simple indicator. Generally, you don't want to be buying something that's below its 50-day. That's a simple rule.
That's great.
And if you just follow that simple rule, it will keep you out of so much trouble.
Amazing, absolutely amazing. Well, listen, John, great to see you again. So, folks, go over to stockcharts.com. You can read John every day. Education, absolutely incredible education, folks. Have a great one, have a safe one. And John, it's always a pleasure, man.
It's a pleasure seeing you again.
You too.